We see the immense wealth, don't we? The huge fortunes of modern dynasties, historical tycoons, it's staggering. But what we don't often see are the blueprints, the actual strategies, the memos, the real mechanics that built these empires. We look at someone like Rockefeller or Bezos and think, genius innovator. Maybe. But sometimes, maybe we should be thinking structural advantage.
That's such a crucial point, because when you really dig into the sources, and we have quite a stack here detailing operations from, Carnegie right through to Silicon Valley, you see it again and again. Massive wealth isn't just about a great idea. It's often far more about locking down control.
Absolute control.
Control over what, exactly? Control over markets, definitely. Control over information flow. And, maybe the toughest part, control over the people, the workforce.
Okay, so that's our mission for this deep dive then. We've got these sources detailing the often pretty ruthless, sometimes controversial methods used across centuries. We want to kind of distill the core strategies, the ones that are often hidden, that let people build up this absolute power, and show how, maybe frighteningly, the 19th century playbook is still very much alive today.
Absolutely. And I think if there's one takeaway before we even jump in, it's this. These fortunes, old and new, they're often built by making the system itself work for them. Innovation might light the spark, sure, but it's the structural control. That's what creates the empires that last. That's what makes them almost untouchable.
Right. Okay, let's get into it. Let's unpack this. We really have to start with the original monopolist, don't we? They kind of wrote the book on control. John D. Rockefeller, his pursuit of eternal vigilance. What did that actually mean in practice?
Oh, eternal vigilance for Rockefeller. It wasn't just a slogan. It was an operational demand, especially in his refineries. Standard Works, Excelsior, he was obsessed with detail, a true micromanager. The sources paint this picture of him, pacing the refineries, hands behind his back, checking everything.
Looking for tiny leaks, things like that.
Exactly, tiny leaks, an unswept corner. He'd apparently praise workers for noticing these tiny things, because for him, eliminating every single scrap of waste, maximizing every bit of efficiency, that was the weapon. If you were more efficient than everyone else, relentlessly so, you just ground down the competition.
And it wasn't just external control. The sources mention his internal control, too. His own temper.
Yeah, that's fascinating, isn't it? He saw an ugly temper, as he apparently called it, as a serious business risk, something to be actively managed. He worked hard, it seems, to control his own emotions, never letting ego or, getting angry dictate a business decision.
Why? What was the strategic advantage there?
Well, think about it. Many tycoons back then were known for being loud, intimidating, explosive tempers. But Rockefeller seemed to realize if you let anger or pride drive you, you become predictable, vulnerable. He aimed for pure, cold calculation, financial logic above all. It made him, frankly, a terrifying negotiator. He sort of outsourced his feelings to maximize the structural gain.
Okay, so he uses these incredibly focused, maybe ruthless tactics to build the monopoly. But then he works just as hard creating a story around it.
He did, and this is where you see this powerful need for justification. Later in life, he spent incredible energy building this narrative, publicly, privately arguing that his actions, even the most anti-competitive ones, were actually for the best.
He really thought Standard Oil was beloved.
Apparently so, or at least that's the story he told himself and the world. He argued Standard Oil was praised, even loved, for bringing cheap kerosene to the masses, lighting up America. He expressed, zero regret. Even when directly confronted later on, it points to this deep psychological need, maybe, to see himself as a moral force, despite the methods. He wasn't just selling oil, he was selling a story about himself.
It's a stark contrast to someone like Andrew Carnegie. His model seems different, more about delegation, particularly to Henry Clay Frick.
Absolutely. Frick was essential to Carnegie. He was the operational fist, maybe? The guy who handled the really dirty work, fighting unions, crushing competitors, while Carnegie played the grand strategist, the philanthropist on the world stage. The sources describe Frick as a master accountant, brilliant with numbers, but also resolutely anti-union and a master strategist in labor disputes. He wasn't just tough, he was strategically ruthless.
And that ruthlessness went straight to eliminating competition, right? That's a core part of the blueprint.
Oh, definitely. Take the South Pennsylvania Railroad incident. It's a classic example. Carnegie didn't need to build a better railroad or run it more efficiently. He just needed to kill the competition structurally. By agreeing to sell his stock in that railroad, he knew it would basically pull the plug. It was the death knell, as the sources put it, for that competing line.
So it wasn't about business competition in the usual sense. It was a power move.
Precisely. A strategic transaction designed purely to remove a threat, starve it of capital and commitment, ensuring Carnegie Steel kept its logistical edge. It's pure power projection.
And maintaining that power meant keeping secrets, especially about how much money they were actually making.
Yes, and this connects directly to what you called structural advantage earlier. It's about hidden subsidies. Carnegie explicitly told Frick to hide the sheer scale of their profits. There's a quote where he says reporting $500,000 a month is out of all reason.
Why hide it? Bragging rights, surely.
No, it was purely strategic. The sources are clear. If the public, and crucially politicians, knew how insanely profitable they were, it would be politically impossible to maintain even minimal protective tariffs on steel.
Ah, so the tariffs were government protectionism, helping them against foreign competition.
Exactly. A massive structural subsidy, essentially. Keeping their profits secret wasn't just about dodging taxes or avoiding envy. It was a political strategy to keep that government-backed advantage in place. They understood their empire rested just as much on manipulating politics as it did on making steel.
Okay, that link between market dominance and controlling capital flows. That takes us right into the world of finance. Where the old tycoons had tariffs, Wall Street had other tools, stock pools.
It's a seamless transition, really, from physical control to financial and informational control. Look at J.P. Morgan's era leading up to the crash. Even at the prestigious House of Morgan, manipulation was, well, it was part of the game. Between 1927 and 31, Morgan was involved in, over 50 of these things called stock pools.
Can you quickly break down what a stock pool actually was? How did they work?
Sure, think of it as a kind of organized pump-and-dump scheme run by insiders. A group of wealthy investors, a syndicate, would secretly agree to buy up a lot of shares in a specific stock. Then they'd work together to artificially inflate the price. Not through real demand, mind you.
Yeah.
They'd hire PR agents, sometimes even bribe newspaper reporters, according to the sources, to talk up the stock, create hype.
Get the public excited.
Exactly. Once the ordinary investors jumped in, chasing the rising price, the pool members would coordinate and dump all their shares. They'd make a killing, and the public would be left holding the bag as the price collapsed.
And this wasn't seen as illegal or deeply unethical.
The sources suggest it was kind of an open secret among the elite, maybe even seen as racy and glamorous. It was just how the game was played if you had the capital and the connections. Legalized manipulation, essentially.
So fast forward a few decades to hedge funds like Stephen A. Cohen's SAC Capital. The manipulation seems less about brute force pumping, more about information.
Precisely. It shifts towards informational arbitrage, speed and access. And SC Capital, well, the sources on them are pretty revealing about how they sought that edge. It wasn't just about hiring smart analysts, it was about hiring people with the right connections.
What do you mean?
When they looked for new traders, the documents show they explicitly prioritized candidates based on their personal connections to insiders at public companies. They were mapping social networks for potential leaks.
Can you give an example? How specific did it get?
It got really granular. A hiring file might specifically note that a candidate shared a summer house in the Hamptons with a tech executive. That was a major plus.
Because casual conversations could lead to valuable information.
That was the bet. That privileged social intimacy creates opportunities for unguarded comments, for insider tips. The network itself becomes the intelligence asset. Prosecutors later called Cohen's firm a veritable magnet of market cheaters because the whole structure incentivized finding and using that kind of non-public edge.
The advantage shifts from owning the rails to owning the information highway. And that idea of controlling a specific market niche, Michael Milken and junk bonds, feels like a prime example.
Milken is fascinating. He basically created the modern high-yield or junk bond market in the 80s, and because he created it, he had this extraordinary control over it. He knew the players, the prices, the flows, and the sources detail how he used that control, not just to make money on fees, but to actively manipulate prices to reward allies, like the arbitrager Ivan Boesky.
Okay, walk us through that. Sounds complex. How did he manipulate prices to pay people off?
Right, it's intricate, almost like financial engineering. So Milken, through his firm Drexel Burnham Lambert, would buy certain junk bonds back from Drexel clients, often at prices the sources call artificially low. Maybe these clients didn't know the real value, or maybe they owed Milken a favor. They sold cheap.
Right.
Then Milken would turn around and sell those same bonds, maybe slightly higher, to Boesky. Boesky now holds the bonds briefly, then he sells them back, often to other Drexel clients, but this time at a much, much higher price.
Wait, So Drexel's own clients were selling low and then buying high, all orchestrated by Milken.
Essentially, yes, the client base became the source of the profit spread. Milken could generate profits for himself and settle debts he owed to Butesky, all by using his chokehold on this specific market. It shows how total control in one area can become this self-feeding machine for transferring wealth, far beyond just earning commissions.
Okay, so blueprint number 1 is securing the market, the monopoly. Blueprint 2, just as critical it seems, is controlling the workforce, keeping labor cheap, productive, and crucially disorganized. Carnegie Steel after the Homestead strike? The sources sound pretty chilling on how they systematized union suppression.
Homestead in 1892 was brutal, a violent defeat for the Union, but it clearly taught Carnegie and Frick a lesson. Never again. Don't let collective power even start to form. So after that, they didn't just repair the steel mill, they built an anti-labor system right into the structure of the company.
What did that system look like?
Well, the sources talk about a new Bureau of Information. Sounds harmless, right? It wasn't. It was basically an internal spy agency. Its job was to coordinate spies within the workforce, to identify anyone thinking about organizing, anyone seen as a troublemaker.
And once identified.
They were out immediately, quietly fired. The goal was preemptive removal, keep the plant non-union, period. It was continuous counter-surveillance built into management.
And for the workers who remained, what was the message?
Zero tolerance, absolutely zero, enforced by guys like Charles Schwab, who ran Homestead later. The sources say Schwab made it clear. Even a tiny argument, a squabble between a former striker and one of the strike breakers brought in, would trigger an immediate investigation, and the outcome was basically predetermined. If you were seen as pro-union and hassling a strike breaker, you were fired on the spot. No mediation, just cleansing the workforce.
It's raw power. Disagree with how things are run, your history.
Yeah.
Which contrasts, interestingly, with Henry Ford's approach. It seemed softer, more ideological.
Yeah, Ford's fascinating. He represents the paternalistic, ideological side of labor control. Where Frick used spies and force, Ford used his public image and, importantly, the paycheck. He genuinely seemed to oppose unions on principle. He argued that a worker joining a union lost their independence, their individuality. His ideal was this direct relationship, a private contract between him and each single worker.
But then there's the $5 a day, that massive wage increase. How did that fit in? Wasn't that pro-worker?
It was brilliant PR, first off, made him a global hero, headlines everywhere, shielded him from the robber baron attacks, but operationally, it did several things. It made Ford jobs incredibly desirable, cutting down turnover drastically, and it allowed him to demand total loyalty and obedience. If you're paying way above market rate, you can make stricter rules. You eliminate the need for a union, in his view.
So the high wage was actually a tool for control.
Absolutely, wage discipline. He famously said workers could ask him to do anything, bug him, but they couldn't drive him, meaning he'd listen to an individual plea, reinforcing his own power and benevolence. But collective demands, organized pressure, structurally impossible in Ford's world. It had to be individual submission.
That idea of avoiding collective power, even through different means. You see echoes in early franchising too, right? Like Ray Kroc and McDonald's.
Definitely. Kroc had a different challenge in the post-war era. How do you scale up fast, keep everything consistent, but also deal with this rising worry about big corporations, government regulation, antitrust? His franchise strategy was, in part, a way to manage that risk.
How so? By spreading it out.
Exactly. Dilution through scale. He focused on super fast expansion, but initially took only a tiny percentage from each franchise, like 1.9% of sales. This did two things. One, it made the McDonald's empire look like lots of small independent businesses, harder for regulators to target as one giant monopoly. Two, it sold the American dream, be your own boss. This tapped into that same individualistic drive Ford leveraged, making it harder for, say, franchise employees across the system to organize collectively. He built an empire by selling off little pieces of it.
So the core principles, control markets, control labor, they persist. But the tools change. Modern tech giants seem to follow a blueprint of hypergrowth, often just steamrolling existing industries. Jeff Bezos at Amazon, his ebook pricing strategy seems like a key example.
Oh, the $9.99 ebook price point, that was pure strategic warfare. Amazon deliberately set that price knowing they were losing money on many of those sales because the wholesale price from publishers was often higher.
Why on earth would you intentionally lose money on your main product?
Yeah.
That sounds like terrible business.
It wasn't about making money on that specific book sale. It was a long-term power play, an investment in market domination. Bezos believed, as the sources quote him, that customers are smart. They'd see digital should be cheaper, and they get anchored to that $9.99 price. Once customer expectations were locked in, Amazon could use its massive market share to basically force publishers to lower their wholesale prices to fit Amazon's model.
Sounds like predatory pricing,
Yeah.
using size to kill competition.
It absolutely has the hallmarks of it, subsidized, arguably, by profits from other parts of Amazon like AWS. The goal wasn't profit then, it was structural control later. Dictate terms to an entire industry. Same playbook as Rockefeller, really, just digital.
And that relentless focus on scale, it caused friction inside Amazon too, even with key early people.
Yes, the sources mention significant resentment, specifically Shelkafan, who was incredibly important in the early days, the engineer who basically built the technical foundations of Amazon. But as Amazon scaled up, he was sidelined, removed from key decision-making loops. Kafan himself called it a betrayal of a sacred trust. It suggests that for Bezos, the mission, the relentless scaling, trumped everything. Personal loyalty, founding partnerships. The machine itself was paramount.
Building the machine, that leads perfectly to Elon Musk. His focus isn't just the car or the rocket, but the factory itself.
Right. Musk takes a very different path from, say, Steve Jobs. Jobs obsessed over the product design, the iPhone, but famously outsourced the actual making of it, mostly to China. Musk argues the opposite. He believes designing the factory, the machine that builds the machine, as he calls it, is where the real, sustainable, competitive advantage lies, often even more critical than the product design.
So he wants vertical integration, control the whole process.
Total control. Obsessive focus on manufacturing, on automating the factory itself, integrating battery production, software, everything. This creates a huge barrier to entry for competitors. It's not just about patents. It's about mastering immense production complexity. That physical operational control is the moat.
And that obsession with speed, control, efficiency, it takes another form in high-frequency trading, right? Where the edge is purely informational velocity.
Exactly. HFT firms like Jane Street operate on timescales we can barely comprehend. Milliseconds matter. Physical proximity to exchange servers matters. There's this incredible anecdote in the sources about the 2016 U.S. election night. It perfectly captures this edge.
What happened?
So the whole world is watching CNN, waiting for state results, right? The market is reacting slowly based on those public announcements. But firms like Jane Street, they were plugged into raw data feeds, early vote counts from key precincts, like in the Florida Panhandle. Their algorithms saw the trend, indicating a likely Trump win before CNN could analyze and report it. Their internal probability reportedly flipped from like 5% to 60% almost instantly.
Wow. So they knew before the market knew.
For a few crucial seconds, yes. They could trade on that information asymmetry. The sources say the market was moving at the speed of CNN, but they were moving at the speed of data. They could execute huge trades, capturing that tiny window of opportunity created purely by the speed of their information network versus everyone else's. Minimal risk for them, massive potential gain.
And this kind of internal knowledge, these algorithms, they're so valuable that firms will pay people just to not leave.
Yes, the cost of doing nothing. It sounds weird, but it makes sense. You might pay a star trader millions in bonus just to stay put, even if they're not having a great year. Why? Because it's cheaper than letting them walk out the door and take their knowledge about the algorithms, the strategies, the understanding of how the firm makes money to a competitor. The real asset being protected isn't just the trader, it's the proprietary system, the informational edge itself, #5V, the societal cost of concentrated wealth and automation.
So we've traced these blueprints across time. Monopolies, labor control, information control. And they clearly work for accumulating power and wealth. But there's a societal cost, right? Which brings us to the work of economists like Thomas Piketty on wealth concentration.
Piketty's research is really stark. It lays bare just how concentrated wealth ownership is compared to income from working. He shows that in pretty much every society we have data for, the bottom half of the population owns almost nothing, like less than 5% of the total wealth. Meanwhile, the top 10% own the vast majority, often over 60%, sometimes much more. It's like two completely different economic realities existing side by side.
And is this getting worse or better? Are we heading back to historical extremes?
We're heading back. Piketty's data shows this big U-shape. Inequality, wealth concentration, it dropped significantly in the mid-20th century, largely due to the shocks of the world wars and subsequent regulations. But since around the 1970s, 1980s, it's climbed dramatically again, to the point where by 2010 or so, U.S. inequality levels were back to where they were in old Europe right before World War I. Structurally, we're echoing the Gilded Age.
And he had a core reason for why this happened, something about capital versus growth.
Yes, it's his famous formula, RG, where R is the rate of return on capital, think investments, property, stocks, and G is the rate of economic growth, which is mostly linked to wages and overall output. When R is consistently higher than G, wealth concentration isn't just likely, it's almost mathematically inevitable, especially in societies where overall growth, G, is relatively low, like many developed economies today.
Can you break that down? Why does R being greater than G drive inequality?
Sure, imagine capital earns a return of, say, 5% per year, or 5%. But the overall economy and average wages only grow by 1% per year, G 1%. The wealth held by those who already own capital just compounds much, much faster than the income earned by people who primarily rely on wages. You don't even need to be a financial genius. The existing capital just grows on its own, outpacing labor income. So unless something disrupts it, wealth naturally flows upwards and concentrates. Large pools of capital just get larger.
Okay, so you have this underlying economic engine concentrating wealth. Now, layer on top of that the AI revolution. We've seen automation hit manufacturing, blue-collar jobs. What happens when AI comes for white-collar work?
That's the next huge wave, and the sources suggest it's going to be deeply disruptive. Experts are predicting a major impact on professional jobs: lawyers, doctors, analysts, coders. These jobs used to seem safe because they involve lots of different tasks, task diversity. But AI is getting sophisticated enough to handle that complexity.
What's the mechanism?
One model experts talk about is the human veneer. Think about jobs with a lot of human interaction. Maybe a teacher, a therapist, even a high-end salesperson. The AI takes over all the complex background work. The data analysis, the research, the planning, the optimization, all the stuff that generates efficiency. The human worker is increasingly left doing just the front-facing part. The empathy, the social connection, the human touch.
So the human becomes the interface, while the actual value-generating computation happens in the machine.
Pretty much. The risk is that the human role gets de-skilled, devalued. You're doing the emotional labor, which is often draining and lower paid, while the core intellectual work, the bit that drives profit, gets automated and captured by whoever owns the AI system. The efficiency gains flow up to capital, to the owners of the algorithms, the data centers, the machine that builds the machine, again.
Okay, so pulling this all together, we've seen this consistent thread, haven't we, across centuries, from Rockefeller to Cohen to Bezos. Building and keeping massive power seems to require this relentless drive for control.
Absolute control. Control over the market, manipulating it, shutting down rivals. Control over information, keeping secrets, or using speed as a weapon. And deep structural control over labor-preventing organization, shaping ideology.
And the sources really drive home that these huge fortunes, they're not always just the result of brilliant innovation. They often rely heavily on securing these sort of non-competitive structural advantages.
Exactly. Like Carnegie hiding profits to keep tariffs, or Milken using his monopoly position to funnel money, or Amazon using its scale to force down prices. These are systems built to channel wealth upwards, often using hidden subsidies or sheer market power to dictate the rules of the game.
These are the blueprints. And they show that creating that level of wealth for a few can often involve, well, extracting value or suppressing the power of many others.
Which leads us to the really big question for right now, doesn't it? We see wealth concentration returning to levels that historically preceded massive social instability. The early 20th century wasn't exactly peaceful, and now we have this new technological force, AI, that promises to automate not just manual labor, but cognitive labor too, on a scale we've never seen.
So if that structural power owning the data, the algorithms becomes even more concentrated in the hands of a tiny elite. And if the basic economic engine of RG keeps widening the gap, are we actually prepared for the fallout? The social consequences, the political upheaval that could come from such extreme concentration and widespread displacement? Who bears that cost?